Give a chat about externalities and deadweight loss. The question here is trying to understand the concept of deadweight loss before we had the presence of externalities. So let's say before the presence of externalities, I have this little graph here, and I say with my supply and demand. And it's when I have my output that is restricted to a different quantity than this quantity here, called a Q star, is where I would say that we would have deadweight loss. So whether it's through the introduction of a per unit tax over here that would reduce the quantity to a smaller quantity, whether it's through a price control or something else, we would have a presence of a deadweight loss. So let's say I introduce a little tax switch here. So this is my price paid by my consumer, my price received by my producer, and this is the difference between the two is the tax. So here's my tax collected. And we say that this little portion here is a deadweight loss. Okay, the reason why that's the case, we have a deadweight loss there, is for this simple reason that right now with this tax we'll have a smaller quantity. Well, what would happen to these extra units? So let's say that we are producing 80 units where normally we would produce 100. Well, why do we say that there's a loss to society on these 20 units that aren't produced? Well, we always say that the demand curve represents our willingness to pay, and our supply curve represents our production costs. So here, for this 81st or 82nd up to 100 unit, I have a willingness to pay that's up here, and I have a production cost that's down here, same for the next unit, and so on and so forth. So therefore, because my willingness to pay, or the value that this product has to society, is greater than the cost of producing it, not producing it is a loss to society. Therefore, we say that the free market quantity, Q star, gives us the right amount of production and has no deadweight loss. And if we restrict output, we do create a deadweight loss. So this was the situation here with no externality. Okay, how does this change once we introduce an externality? So in the chapter that we deal with externalities, we change a little bit the wording, but it's not a big difference. So let's say I were to look at a negative externality. So here in this case, we say that we have a marginal benefit curve, which is essentially our demand curve, our willingness to pay curve. And we have a marginal cost that is private. We say that's just our typical marginal cost that we had before. But now we say that in the presence of this externality, we also have, if it's a negative externality in this case, we will have a social cost. So if we have a social cost, that means that for whatever amount of quantity here that is being produced, we will have this private cost, and we will have a little bit more as a social cost. So if we add the social costs to the current private costs, we will have the marginal social cost. Okay, so this distance here is represented by this negative externality. So what's going on here? Well, if we ignore the externality like most businesses do, they don't really take into account the damage that they can have on climate change, which can destroy the Great Barrier Reef and different things like that. So if they're just thinking about their own private costs and don't really care about what happens to society, well, what will happen is they're going to produce at this intersection here, or we could think the same about smoking. So this would be my typical production. Okay, Q here, I'll just call it Q in this case here. But what's going on at this typical production level where this smoker has a certain amount of benefit, he has his own private costs, he doesn't really take into account the cost that he's bearing on other people by secondhand smoke or by higher healthcare costs, expenses, because smokers lead to many forms of diseases and stuff like that. So there's something missing here. So when we add that thing, this is this marginal social cost. So this is the quantity that's being produced. But at this quantity, we say that there's something not going well. We say that ideally, because of this negative externality, we should take into account all costs. So we should be looking at this intersection here and this quantity here. That's lacking a little bit of space, but is the quantity that we say is allocatively efficient. It's the best kind of quantity based on all of these externalities and everything else here. So this is what we should be producing. This is what the free market produces. So what happens when we produce at the free market? Well, let's look at the last units produced. The last units produced before, when we got to this Q star here, the last units produced still had a greater benefit to the consumer than production cost of the firm, so it made sense to produce these. If we look at these last units produced here, yes, the benefit to the consumer is greater than the private costs, therefore there's a benefit here. But if we compare the benefit of the consumer versus the social cost, we can notice that here we've got actually a loss. We've got a loss from producing that unit, we've got a loss from producing this unit, we've got a loss from producing this unit, we've got a loss. Why a loss? Because my social cost of that unit, the total cost, is greater than the actual benefit, which is represented by this curve here, of producing it. So all of this, in this case here, leads to a deadweight loss for these units. Leads to the exact same thing as we were talking about earlier, but in this case, the very important thing to note is when we have the presence of an externality, market failures leads to a situation that we're not producing the right quantity of goods unless we have government intervention. So this is, in this case here, with no government intervention, we end up with the right quantity, which has no deadweight loss. Here, with no government intervention, we actually end up with a deadweight loss. Whether we're dealing with a positive or negative externality, it's just going to kind of be flipped a little bit. We still end up with the same situation. So the deadweight loss occurs when there is no government intervention because we're producing the wrong amount of quantity. We're overproducing in this case because we're not taking into account the extra damages that this product does. So therefore, we need to find a way, ideally, to intervene and reduce this quantity from what's normally produced to this better allocation. And this better allocation could be introduced by, I don't know, quotas, laws. So if we're thinking about cigarettes and stuff like that, there's more laws prohibiting people from smoking in certain places. So naturally, that's going to make people smoke a little less. But we also think a lot about taxation, so carbon taxes and other things like that also reduce the actual quantity sold, because we saw here with a tax, it's going to reduce the quantity exchange, because as you introduce this tax on the producer or the consumer, it doesn't really matter. We're going to have a higher cost, therefore it's going to lead to less production. So once we introduce this tax, let's say we were to introduce a tax here, and it would reduce this quantity to this quantity that is allocatively efficient. In this case here, if we choose the right tax, we could end up with no deadweight loss. So the big idea here is with no externality, free market quantity is optimal. What I mean by here is there's no deadweight loss. And when we introduce a tax or something else, tax or other distortion, leads to a deadweight loss. Whereas when we have an externality, whether it's positive or negative, the free market quantity is not optimal. And actually, this normal quantity leads to deadweight loss. But tax for a negative externality or subsidy for a positive externality or other distortion if done appropriately, like you have to have the exact amount, leads to a reduction of the deadweight loss or no more deadweight loss. So in this case here, if we think about it, for society, if we had to choose what goods to tax and we wanted to make things as optimal as possible, we wouldn't tax anything that has no externality associated to it. But if we could only tax goods that had negative externalities associated to it so that the consumption of those goods would be reduced, well, then it would be a better situation for society because those taxes, once again, serve the purpose of distorting behavior, but also serve the purpose of collecting money to fund social services. So those taxes that would be used to collect money would actually not lead to negative distortions, but actually could correct positive distortions. So that's why some people are advocating the use of a carbon tax to reduce greenhouse gas emissions, but also it would raise a certain amount of money, and with that money raised, we could reduce taxes on income taxes and stuff like that, because in that case, we don't really want to try to find a way to reduce people working. We don't want to promote people from not working. We actually want to encourage them to work as much as possible. So if we could reduce the taxes on every hour that they spend working, it's going to create a greater incentive to work, which is also a positive thing. So that transfer of taxes from one another is good for the environment, but is also very good for society. So in a nutshell, that's the kind of parallel that you have to look into once you get into this chapter on externalities to understand the distinction between the two. Thanks.